1.75 billion ounces. That's how much silver China hoarded before November 1935. 1.75 billion ounces accumulated over centuries. At today's prices, that's $127 billion worth of silver. And then, on November 4th, 1935, China did something that sent shockwaves through global markets. They nationalized it, all of it, called it in from circulation, sequestered it in government vaults. The world was startled, according to Foreign Affairs at the time. But here's what nobody talks about. That wasn't the beginning of the story. That was Act 3. Act 3 of a 4-act play that's been performed throughout history. And right now, 90 years later, we're watching the same pattern execute. Same country, same metal, different century. Because on January 1st, 2026, in 11 days, China is essentially doing it again. Not a nationalization this time, but close enough. Export restrictions that will choke off 60 to 70% of global silver supply to Western markets. And if you understand what happened in 1935, if you can see the pattern, you will understand why silver just hit $67.30 and why this story is far from over. Let's start at the beginning. 1873. The world is changing. Germany, France, and the United States, one by one, are abandoning silver and adopting the gold standard. It's called the crime of 1873 in America. Silver gets demonetized. Its value plummets. And suddenly, there's one country left standing. One massive economy is still using silver as its monetary foundation. China. China had been using silver for over 1,000 years. Not just coins. Silver traded by weight. Silver ingots, silver chunks, silver dust. Every transaction was what historians called an encounter of wits because you had to weigh it, test its purity, negotiate its value. There was no unified national currency. Just silver in various forms, flowing through the world's most populous country. And when the rest of the world moved to gold, China became, as Foreign Affairs put it, the marginal buyer. China's requirements dominated the price of silver globally. Between 1918 and 1931, China imported 1 billion ounces of silver. 1 billion. That's 30% of total world mine production during that period. Think about that scale. The world mined silver, and a third of it flowed into China because China needed it. Their entire monetary system ran on it. Their economy depended on it. Silver was money in China in a way the West had forgotten. But here's where the pattern starts. Here's Act 1, debt and instability. After the fall of the Qing dynasty in 1911, China descended into warlord-era chaos. Regional military leaders issued their own currencies. Japanese forces occupied Manchuria in 1931. The nationalist government in Nanking was fighting communists, warlords, and foreign invaders simultaneously. And all of that costs money, massive amounts of money. So they borrowed. Foreign loans, development loans, currency stabilization schemes. China's debt grew. And as debt grew, the monetary system became increasingly unstable. Multiple competing currencies, regional banking systems, capital flight. Sound familiar? Act 1, borrowing beyond capacity while facing external pressures. The trap is being set. Then comes Act 2, external pressure that accelerates the crisis. 1934, the United States passed the Silver Purchase Act. Franklin Roosevelt's administration, under pressure from Western silver mining interests, decides the U.S. government will buy silver. Lots of silver. They set a price floor. They create demand. And suddenly, global silver prices start rising. For most countries, that's irrelevant. They're on the gold standard. Silver is just another commodity. But for China, silver is money. And when the price of your money starts rising internationally, you have a problem. The higher the silver went on global markets, the more profitable it became to smuggle silver out of China. You could buy silver inside China at the official rate and sell it outside China for a massive profit. Silver started hemorrhaging out of the country. Shanghai silver stocks plummeted. Between 1934 and 1935, China lost hundreds of millions of ounces. And here's the kicker. As silver flowed out, China's money supply contracted. Deflation set in. Prices fell. Businesses collapsed. According to economic data, wholesale prices in Shanghai declined by double digits. The Chinese economy, still reeling from warlord chaos and Japanese invasion, started collapsing. The nationalist government tried to stop it. October 1934, they imposed capital controls. They created an export tax on silver, an equalization fee that was supposed to rise and fall to keep domestic and international silver prices aligned. They were trying to close the gap and prevent the outflow. It didn't work. When your currency's value is soaring and your economy is deflating, capital controls are just speed bumps. The silver kept flowing out. Act 2. External pressure meets G internal instability. The crisis accelerates. The government faces an impossible choice. November 4th, 1935. Act 3. China abandons the silver standard. But that's not the headline. The headline is what came next. The nationalization of silver. The government decree stated it plainly. All silver in circulation must be turned into government vaults. Anyone holding silver must exchange it for paper currency issued by the central bank. The government would establish a monopoly on note issuance. One currency, one central authority, and all the silver backing it would be sequestered under government control. Foreign Affairs called it one of the most memorable steps in monetary history. A few more memorable steps have been taken, they wrote, because China wasn't just changing its currency. China was seizing control of 1.75 billion ounces of accumulated wealth. Centuries of hoarded silver, gone. Nationalized. And here's what's critical. The government knew this would be unpopular. They knew enforcement would be difficult. As the article noted, reforms in China do not bear the literal signification that they do in the West. Translation? They knew they couldn't enforce it completely, but they didn't need to enforce it completely. They just needed to assert control. They needed to stop the hemorrhaging. The Japanese were disturbed. Documents from the U.S. State Department show Japanese officials convinced themselves that Britain and America had promised China loans to back this currency stabilization. They asked point blank, has a loan been arranged? Because Japan understood what was happening. China was reorganizing its monetary system. And whoever controlled that reorganization would have enormous influence over the Chinese economy. The Japanese opposed it. They saw it as Britain and America locking them out. Suma, the Japanese diplomat, told the U.S. ambassador that he believed financial chaos would result, that independence movements would spring up in Canton, North China, and Shantung, that regional banking systems would fracture. He was partially right. There was chaos, there was resistance, but the nationalization happened anyway. Because when debt becomes unmanageable and external pressure forces your hand, governments don't have good options. They have survival options. China chose debasement, not by clipping coins like Rome, not by printing endless paper like Weimar, but by severing the link between their currency and tangible value. They replaced silver money with paper promises, and they sequestered the silver itself, the real wealth, in government vaults. Act 3, the debasement, the confiscation, the assertion of state control over monetary metal. And what happened to that 1.75 billion ounces? It disappeared from the global market. China, which had been buying 30% of world silver production for decades, stopped buying. More than that, the silver they'd accumulated was now locked away, off-market, unavailable. The article from Foreign Affairs puts it bluntly. China, which for so long has been silver's major prop, has resigned the worrying about silver to the United States Treasury. The aim of American silver policy was to make the use of silver more extensive as a monetary metal. The result was progressive demonetization and debasement. Think about the irony. America wanted higher silver prices to help Western miners. So they passed the Silver Purchase Act. They bought silver. They drove up prices. And in doing so, they destroyed the silver standard in the last major economy still using it. They forced China to nationalize its silver and go to paper currency. And in the process, they removed the marginal buyer from the global market. Silver prices, which had been rising through 1935, peaked and then started a long decline because the buyer of last resort was gone. China was out. That's the 1935 playbook. That's the historical pattern. And now, 90 years later, it's happening again. Let me bring you back to today. December 20, 2025. China holds roughly 70,000 metric tons of silver reserves in the ground. That's about 2.5 billion ounces. They produce 3,400 metric tons annually, about 110 million ounces. They're the world's second largest producer. But more importantly, China is the refining hub. Silver mined all over the world gets shipped to Chinese refineries for processing. Then it gets exported to Western markets. That flow, that processing capacity, that refining infrastructure represents 60 to 70% of the global silver supply chain. And on January 1st, 11 days from now, China is restricting it. Not nationalizing, not confiscating, but restricting exports through a state trading management system. Only large state-certified companies producing at least 80 tons annually will get export licenses. Small and medium players, locked out. Why? Officially, to protect national resources and the environment. But let's be real. China needs silver. Their solar panel industry produces 80% of global solar panels. Silver paste is critical to photovoltaics. Their electric vehicle industry is massive. Electronics, 5G infrastructure, AI data centers. All of it requires silver. And they're the world's largest consumer. China's domestic demand is outstripping domestic supply. Shanghai Futures Exchange, silver inventories fell below 500 tons in November, record lows. So they're doing what they did in 1935. They're keeping the metal at home. And in doing so, they're cutting off the West. Same pattern, different mechanism. Act 3 repeating. But there's something else happening, something deeper. China has been systematically accumulating strategic reserves of critical materials for years. Rare earth elements, lithium, cobalt, and now silver. They learned from the past. They studied what happened when they controlled rare earths and used export restrictions as geopolitical leverage. Silver is the next rare earth element. And the timing is not coincidental. Global debt hit $318 trillion in 2024, according to the Institute of International Finance. Debt to GDP ratio, 328%. For the first time in 4 years, that ratio increased. We owe more than 3 times what the planet produces annually. The US added over $2 trillion in 2024. China's adding debt, Europe's adding debt, everyone's in a debt trap. We're in the stage where you borrow not to invest but to service previous borrowing. Interest payments consume 15 to 20% of government revenues. The math doesn't work anymore. Same as 1935. Act 2, meeting Act 3. External pressure, meeting internal instability, and meeting monetary restructuring. And silver? Silver is responding the way it always responds. Flight to tangible assets. Silver hit $67.30 yesterday. Up 130% in 2025. Strongest annual performance since 1979. But forget the price. Look beneath it. COMEX, the major commodity exchange in New York, saw 47.6 million ounces claimed for physical delivery in the first 4 trading days of December. That's 60% of registered inventory. Gone. In 4 days. COMEX inventory are S, down 73% since 2020. London lease rates, what it costs to borrow silver, spiked to 9%. Normal is 0.5%. 9% means desperation. Backwardation in the futures market. Spot price exceeding futures. People want silver now more than promises of silver later. Supply deficit? 95 million ounces projected for 2025. 5th consecutive year of deficit. Cumulative shortfall since 2021, 820 million ounces. Imagine draining an Olympic swimming pool every year for 5 years. That's above ground inventories disappearing. Meanwhile, demand accelerates. 200 million ounces for solar panels in 2024. 90 million for electric vehicles. AI data centers there, adding demand. Investment demand is surging. And here's the bottleneck. You can't just mine more silver. 70% comes as a byproduct of copper, zinc, and gold. If those operations slow, silver supply drops regardless of price. My output grew by 1% this year. New projects forecast to add only 44 million ounces over 5 to 10 years. Supply is rigid. Demand is exploding. Inventories vanishing. And now China closes the export valve. Remember 1935. China removed 1.75 billion ounces from the global market through nationalization. The marginal buyer disappeared. But this time it's different. This time, China isn't just removing a buyer. They're removing the supply. They're closing the refining pipeline that Western markets depend on. Western mints are already struggling. Canada's Royal Mint is out of silver bars and coins. The US mint supply is constrained. The London market is tight. And in 11 days, the main supply channel gets choked. So let's zoom out. Let's see the full pattern. Act 1, borrowing and expansion. China, in the early 20th century, borrowed to fight warlords, resist Japan, and build infrastructure. We're doing the same now. Global debt is $318 trillion. Borrowed to expand economies, finance wars, and fund social programs. The debt becomes unmanageable. Act 2, external pressure forces the crisis. For China in 1935, it was America's Silver Purchase Act driving silver prices up, forcing capital flight. Today, it's supply chain stress, industrial demand explosion, and geopolitical tensions over critical materials. The external pressure makes the internal instability unsustainable. Act 3, monetary restructuring and asset control. China nationalized silver in 1935, seized control of 1.75 billion ounces, replaced metal money with paper promises. Today, they're restricting exports, keeping silver at home, asserting state control over supply. Different mechanism, same goal. Control the tangible asset when paper systems are under stress. And here's the pattern within the pattern. When governments restructure their monetary systems, when paper promises come under pressure, what preserves wealth, what holds value across the chaos? In 1935, the answer was the same as it was in Rome, in Weimar, in every monetary crisis in history. Physical precious metals, the people who saw it coming in China, the wealthy families who understood what nationalization meant, they didn't trust paper promises. They smuggled silver out. They buried gold. They converted wealth into tangible form. Because metal doesn't lie. It doesn't promise. It doesn't depreciate at the stroke of a bureaucrat's pen. It just is. Act 4, the reset. This is where we're heading, when the old system breaks completely and gets replaced with something new. In 1935, China's reset was moving from silver to paper currency. But that paper currency had to be backed by something, by foreign exchange reserves, by a new banking system, by international loans. The transition was messy. Today's reset? We're seeing glimpses. BRICS nations are discussing alternatives to dollar dominance. Central banks are buying gold at record rates, over 1,000 tons in 2023. Countries settling trades in yuan instead of dollars. China is restricting exports of critical materials. These aren't random. These are positioning moves for the next system. And silver sits at a unique intersection. It's both a monetary metal with thousands of years of history as money and the most critical industrial metal for the green energy transition. Solar panels, electric vehicles, 5G, and AI infrastructure all require silver. There's no substitute at scale. UBS forecasts $52 of silver in 2025, $55 by mid-2026. Already outdated, we're at 67. BNP Paribas says $100 is possible in the right conditions. Bank of America's technical team is bullish. These are major banks, not speculators. But here's what you need to understand. This isn't about getting rich. That's the wrong frame. Think of silver like insurance. Not home insurance, hoping your house burns down, but insurance because you understand risk. Because if something happens, you want protection. Silver is monetary insurance against currency instability, against the possibility that the pattern continues doing what it's done for thousands of years. The current price, $67, is high by recent standards, but adjusted for inflation, silver would need to hit $125 just to match its 1980 peak. And unlike 1980, when silver ran purely on speculation, the Hunt brothers trying to corner the market, today's driver is structural. Industrial demand, D meeting supply deficiency, TS meeting monetary uncertainty, and meeting geopolitical control. That combination creates secular bull markets that last for years. Let me show you something that should give you pause. In 1935, China's silver nationalization removed 1.75 billion ounces from circulation. At today's $67 price, that's $117 billion worth of silver. It didn't crash the market immediately. But over time, removing the marginal buyer, locking up that much metal, fundamentally changed supply dynamics. Today, China's export restrictions don't remove 1.75 billion ounces, but they choke off 60 to 70% of refining capacity. In a market already running 95 million ounce annual deficits, with COMEX inventories down 73%, with lease rates at 9%, with physical delivery overwhelming the paper markets, the impact might be faster this time, and more severe, because the underlying supply-demand situation is already critical, and China just closed the pressure relief valve. Western industrial users haven't panicked yet. Solar companies, electronics manufacturers, they're assuming supply chains will adapt. What happens when they realize they can't source silver paste? When delivery dates get pushed back? When prices spike, not because of speculation, but because physical metal genuinely isn't available? COMEX shorts are already in trouble. JP Morgan's vault was cut in half, registered inventory at record lows, and in 11 days, Chinese refined silver stops flowing west. The people who sold paper promises of silver, who bet prices would go down, are staring at a supply crisis with no easy out. Because you can't deliver paper when contracts come due. You need physical metal. And physical is disappearing. The 1980 silver squeeze happened because the Hunt brothers tried to corner the market. They accumulated 750 million ounces. The government changed the rules, raised margin requirements. The squeeze broke. Silver collapsed from $50 to single digits. This time is different. This isn't a corner. This is structural. Supply deficits, industrial demand, and geopolitical supply restrictions. No rule change fixes this. You can't print silver. You can't conjure supply. And the main exporter said, we're keeping ours. History doesn't repeat exactly, but it rhymes. And right now it's rhyming with 1935. China, silver, export controls, monetary restructuring, global debt crisis, supply crunch. The pattern is executing. So where does this leave us? What does it mean? We're in Act 3, the debasement and restructuring phase. Global debt is $318 trillion. Governments are choosing inflation over default, paper currency is under pressure, and China is asserting control over critical materials, starting with silver. Act 4 is coming. The reset when the current system breaks and gets replaced. We don't know exactly when. Could be months, could be years. But the pattern says it's inevitable. The math says it's inevitable. And in the transition, in that gap between Act 3 and Act 4, silver performs its historical role. Not speculation, don't get rich quickly. Wealth preservation, insurance, protection against monetary chaos. I can't tell you what to do with your money. I'm not a financial advisor, I'm a pattern recognizer. But I'll leave you with this. In 1935, China nationalized 1.75 billion ounces of silver. At today's prices, $127 billion, the people who saw it coming, who understood what was happening, they protected themselves. They converted paper wealth to tangible form before the window closed. Today, China restricts exports starting January 1st, 11 days. Silver at $67, up 130% this year. COMEX inventories are down 73%. Supply deficits for 5 straight years. Industrial demand is exploding. Lease rates are spiking. Backwardation in futures. Act 3 executes exactly as the pattern says it should. Act 4, visible on the horizon. The only question is duration. How long does Act 3 last before the reset? History says this. When you're in Act 3 and you see Act 4 coming, you position for the transition. Not because you're panicking, because you're aware, because you understand what comes next. Because the pattern doesn't care if you believe it. It just executes. So ask yourself, which act are we in? Can you see the pattern? Drop a comment. Tell me if I'm connecting dots that aren't there or if this resonates. And if you want to see what happened after China's 1935 silver nationalization, what the markets did, how it played out, hit subscribe. Because next week, I'm breaking down the aftermath, the price action, the supply dynamics, the geopolitical fallout, and why understanding 1935 might be the key to positioning for 2026. China flips the switch in 11 days, the supply restriction becomes official, and we'll see if the market is ready. History suggests it's not. The pattern suggests we're about to find out just how tight the physical silver market really is. The pattern doesn't negotiate, it just executes.